Hello, and thank you for joining us. My name is Ian Barnes. I'm the Chief Investment Officer at Netwealth. Thank you for your patience, just as we were resolving some technical issues. Today, we're going to talk about the power of ETF investing, the way that we believe sensible ETF portfolios should be built, the power that they can give both individual investors and professional investors alike in reaching your varied investment objectives. So before we launch into the slide presentation, I would just like to say thank you very much for all of the questions that we've received. And indeed, if we have not captured any of the questions that you may have had over the course of this webinar, then please do get in touch with my colleagues at advice@netwealth.com, and we'll be sure to come back to you. So I'm going to share some slides for most of this presentation and introduce some of the key concepts that we think are most relevant for investors today when using ETFs. So thank you very much again for your patience. We will now consider some of the most important aspects of ETFs. So at Netwealth, we construct a range of different risk-oriented investment profiles. We have typically run 7 different portfolios in each of our 4 ranges. So sterling, US dollar, euro portfolio ranges, as well as an SRI, or socially responsible investment strategy. They all go from risk level 1, which is equivalent to cash or money market exposure, up to risk level 7, which is equivalent to global equities. And the process is designed in sympathy with the overall ethos of Netwealth, which is to get investors invested efficiently, so they can get good exposure to market risks in a sensible and diversified way, helping them to achieve their varied investment goals. And we use technology as a key component of that. So the investment approach is constructed using 3 pillars. The first is our strategic allocations, which form the bedrock of our investment exposures. We reappraise those every 12 months or so and are designed to give exposure to a basket of different asset class allocations, which we think are the best fit for achieving investors' long-term goals. This third part, on the right-hand side of the slide, is our cyclical positioning. That's how we adjust our portfolio exposures through time. We don't trade in and out of assets on a day-to-day basis, but if we think there's a particular risk that we can identify and mitigate within our strategic positions, then we will act to implement some changes. Typically, these are designed to try to smooth the path of returns that investors see, to remove some of the emotional responses that people may come across when faced with volatile markets, such as we've been seeing recently. And we can discuss that a little bit in detail as well. However, the most important thing that we're focusing on today is instrument selection. What are the assets that we put into each of our asset class allocations, and how do we take the exposures that ultimately clients will be investing in? And here is where exchange traded funds, or ETFs, come into play. Now, what is an exchange traded fund? So the financial world is full of lots of acronyms, lots of jargon, but essentially exchange traded funds are investment funds which can be traded like shares, so typically on exchange. Now, there are some nuances which we can go into, but we believe that the development of the ETF industry has been a real boon to investors, helping them to build diversified, efficient portfolios that have given lots of great exposure to different investment markets. But what are the key characteristics of an exchange traded fund? Although we need to differentiate between the underlying investment assets and the structure itself. So the structure is one thing, the fund, which can be traded, as I say, on exchange, but is also has characteristics of a fund. But the most important thing is that it gives exposure to a targeted asset class. So here, an ETF can take exposure to different underlying assets, but the important thing is that they all have what we call good liquidity, i.e. they can be traded on an ongoing basis. ETFs are typically low cost. That's not always the case, and we'll get into that in a bit more detail in due course. But one of the key features that people really appreciate is that investing in ETFs means that not a lot of your money needs to be spent on fees, and therefore more of your money gets invested and generates higher returns through time. The third component is that ETFs are versatile. The reason that they've been so successful is that they provide trading flexibility and operational ease. So unlike traditional funds, which typically have one price point per day, one purchase point or sale point per day, so you have to wait until a particular point in time before you transact your underlying exposure, ETFs can be traded throughout the trading day. Also, they're much easier operationally. They settle just like ordinary securities, like shares on a market, which means that the backdrop behind the scenes becomes much more available for a wide range of investors. And this versatility means that ETFs have been adopted by investors with wide-ranging objectives and areas of focus. And that has helped build this really secure, robust infrastructure that again has had a nice sort of snowballing effect in terms of the popularity of ETFs as a whole. Now, most ETFs are passive strategies. That's why people sort of sometimes think of them as index tracking funds. Most ETFs are passive, but not all passive assets are ETFs. And in addition, active ETFs are also growing. So the ETF industry has grown from about 5 trillion assets under management in 2015 up to $15 trillion right now. Active ETFs are about 1.5 trillion of that, so a small portion, but fast growing. More of the strategy launches that we see coming to market at the moment are active versus the core passive exposure that most people associate with ETFs. The next point is that we see greater transparency than regular funds. Because ETF investors or buyers and sellers need to know what is going on at any particular point in time within a fund, they have demanded over time better transparency. That's true for the investors, but it's also true for the trading counterparties that will take on the risk of holding different ETFs and providing a price for ETFs at a different point in time. So as a rule, ETFs generally have much better transparency than regular funds. The last point that we think is important to remember about an ETF is that they are designed to comply with very specific regulatory frameworks. So just like traditional mutual funds, they have tax and other regulatory constraints depending on the regional launch place where they have been set up. So you can't really buy a US ETF, US domiciled ETF, as a European investor. All of our ETFs are structured as what we call within the UCITS regulatory framework. And because our customer base is mostly UK specific, they're all designed with a UK tax-friendly exposure in mind. So those are the key components of an ETF. When we now think about why we believe that they're so effective through time, we think about what are the alternatives. Now at Netwealth, we are not set up as investors to go and identify individual companies. We don't try to anticipate whether you'll be better off investing in Barclays or Lloyds as a UK bank. We don't make calls between different technology stocks in the US, but we also don't invest in active funds as a rule. We can do, but we find that on the whole, through most different environments and for most different asset classes, investing in ETFs, it produces better performance than the average active manager. We demonstrate that on this table here. So on the left-hand side, we have shown the different asset classes which we invest in for our Netwealth clients, ranging from different equity markets down to fixed income classifications. And across the different columns of the bar, we show the different time periods under consideration. So year to date, 1 year, and then further out to 3 years and 5 years. And we ask ourselves, so what has been the better investment in each of these different categories over each different time period? And you can see that whilst the experience may vary in the shorter term, as you extend the investment horizon out to longer time periods, you see that ETFs generally outperform the active peer group. Now, there are some exclusions from that, and most clearly down at the bottom of the slide, you can see corporate bonds. Now, the corporate bonds is a very interesting area for us because the structure of fixed income markets means that firstly, the universe of available securities is extremely large, but also they have a fixed term life. Different bonds mature and then need to be replaced over time. So the act of running an index tracking passive ETF strategy actually involves quite a lot of work for an ETF manager. So that means that the first important point is that the fee differential between a passive ETF strategy and corporate bonds is not as wide compared to an active manager as it is, say, for UK equities or US equities. So the hurdle for active management relative to an ETF is actually a little bit easier within the corporate bond market. Now, for that reason, we actually take quite a pragmatic approach here at Netwealth and blend exposure between passive and active strategies within corporate bonds. Now, we don't actually have many corporate bonds in our portfolios at the moment because we believe that cyclically it's an area that is slightly expensive and you're not really getting compensated for the different risks that are embedded within the strategy. But as a rule, we could actively consider active management here. Now, we're not the only people to have identified this, of course. I'm minded of the great John Bogle, who's the founder of Vanguard. And there's a great quote that he's got, which says that there's a grim irony for investors that you don't get what you pay for in investing. You get precisely what you don't pay for. So the importance of keeping your costs low just has such an important impact on your net of fee returns. And that's why we focus on ETFs. Other studies have also been done. The well-known SPIVA study in the US has found that since their study launched in 2002, there's only been 2 years when a majority of US equity active managers have outperformed the main benchmark there. And that's in 2007 and 2009, right around the global financial crisis. Every other calendar year, you've seen an average manager underperform in the US. And of course, that characteristic just compounds over time. So what makes a good ETF? And that's a slightly different question, of course. So here I've tried to outline the different themes that I think are particularly important when considering ETFs and what we look for at Netwealth. Now, there are some overlapping relationships with what we've listed below. You can see that some of the themes might be interdependent, but I think it's also quite important to consider each one in turn. So on the left-hand side, we've got the investment characteristics. So what is the focus of the ETF in question? And on the right-hand side is what are the more functional or operational considerations that we think are important. So starting on the top left, we think that the market that you're investing in has to be relevant. Now, there are any number of different European equity benchmarks that are an index tracking or passive fund could follow. They all have different nuances, and we're going to show some of that in a short while. But you need to be very clear that the market that you're trying to get exposure to is relevant for your overall portfolio. If you think about the US market, the characteristics of the Dow Jones index, with its very small number of constituents, largely historic names that is only very slowly evolving, and actually the way that the index is put together in terms of its weighting is very different from something like the NASDAQ index. So as an investor, you need to be very aware of what the underlying characteristics are of the index that you're targeting. For our purposes, we try to get the balance right between providing exposure to a liquid, and that's a word that's going to come up on a repeated basis through the course of this presentation. It's going to have liquidity, it's going to have breadth, it's also going to be focused on what we think are the most important stocks as well. The second part is that the market needs to be durable. We tend to invest in very core strategies because we're trying to provide very diversified exposures to different capital markets. But there are different themes that can be expressed through an ETF. We believe that the risk of investing in sort of niche or very overly engineered markets is that they're not going to always remain popular. And you may find that investing in such a particular market is not actually going to give you sustained good outcomes over time. So we look for durability of the investment theme as well. The third part is transparency. Now, how clear is the underlying exposure that you're taking exposure to? So not just the names of the different securities in, say, if you're investing in equities, or the individual bonds that you might be considering within fixed income or commodity exposures, but also how transparent are in how clear is it what the characteristics are going to be of a particular investment. If you invest in say an ETF focused on the Korean market, which is an area that we find quite interesting at the moment, is that something that is going to be driven by one or two particular company names, or is it going to be driven by a number of sectors, or perhaps exposure to very idiosyncratic Korea country specific factor risk? So a level of transparency of what is actually going on in the instrument is also important. On the right hand side, going back to these more functional aspects, we think about whether or not an ETF is reliable. What does that mean? Well, does it provide you with all of the targeted exposure all of the time? Can investors get access to the prices that they think they're going to get access to? Will it be traded in more difficult markets? Or is it going to be a little bit sketchier? We've seen several instances of periods of market volatility where the management teams of certain ETFs haven't been able to provide clear, reliable exposure to the market that they're intending to give exposure to their clients. So that's a really key feature for us, and it sort of captures a few different aspects. Efficiency, we've spoken about a lot. efficiency is a key theme, and it comes down to more than just costs. Now, ETFs tend to be a very scalable business. So the good ETFs tend to get more successful over time. Part of that is an aspect of being able to provide exposure at low cost. It means low management costs, which can be between 0.03% as an annual fee for a large scale ETF within the US equity index. Could be something like 0.07% for a UK equity index. But beyond that headline fee, how you are able to trade it and what the level of spread is between the buying and selling price on any given day is at least as important as the headline cost. Now at Netwealth, we tend to trade our ETFs once per day, either driven by flow of new clients coming in or investors divesting if they're in a drawdown strategy, or perhaps we're doing a rebalance. Everything will be done all together. We collate all our client flow in one way to make it as efficient as possible. So we need to know when we're executing how we're going to be able to make that as efficient as possible. And then again, it comes down to dependability. The last point is really well sort of related to that point, and the ETF needs to be well supported. So that might mean a good capital markets team within the management company, but it also means how many of the trading counterparties are actively interested in providing a market for this ETF, because you're trading at different points in time. And that's, we find, is a real differentiator between the different ETFs that we look at. But then underpinning all of this is this question of liquidity. We believe that strategies need to be liquid, both in terms of the asset that they are trying to give exposure to, but also the actual instruments in which they invest. And that can really vary over a range of different regions, markets, but also instruments themselves. So that's always front of mind. And that crosses from the investment characteristics as well to functionality. So all in all, we're looking for ETFs that give an effective representation of intended market exposure. So let's think about ETFs in action. Within the Netwealth portfolios, as I say, we think about a lot of different things. Investing in ETFs should be simple. It's not necessarily always that easy. So the choice of ETF matters. Now, this slide shows 4 different ETFs across the top. The first 2 are UK-oriented instruments. The second 2 focus on the European market. The UK, we look at large and small companies on a strategic basis. Historically, we've only had a strategic exposure to the large companies within Europe. And you can see that the underlying characteristics are somewhat different when you think about the exposure to different sectors. So the types of companies that make up each ETF. And here there are some commonalities, but there are also some differences that we think are important. Financials within across European markets, including the UK, are quite important. If you take a position in a European ETF, you're likely to take some exposure to financials. But there are nuances within that, whether that's banks or asset managers or insurance companies can all have a different response to different market environments. On the UK FTSE 100 index, there's a big difference between what we would consider more sort of stable assets and cyclicals. So consumer staples make up a meaningful component. Energy makes up a meaningful component. Real estate, much less so. Communication services and consumer discretionary, much less so in compared to the other choices that we might have available. The final point I would make here is that there's also a big difference in terms of what the look-through currency exposure might be that you inherently have when investing in different instruments. So larger companies in the UK actually only get about 25% of their revenues from UK-oriented business, and it's as much exposed to the US at around 20% as it is to the UK. European assets have a much more domestic feel. So large cap companies within Europe have about 40% of their revenues derived from the European Union. Smaller companies have more than 50%. And that's actually one of the reasons why we have taken a cyclical position currently in the ETF on the right, because we wanted to just increase our exposure to Euro-centric revenues at the moment, but also just slightly reduce our exposure to financials, which you can see there. So having a good understanding of what goes on underneath the bonnet of your ETF is vitally important. Another characteristic that I wanted to highlight is the ability to change the exposure of your currency exposure on a very explicit basis. Now, on a strategic basis, we have historically hedged all of our euro exposure that's inherent within the European market back to sterling. We have found that when people are positive about the Eurozone as a whole, European equities tend to benefit at the same time as the euro rallying against sterling. So from our point of view, they don't provide as much diversification as you might want to own. What I've shown here is the relative performance of two different ETFs. The one in the navy blue is the European market hedged back to sterling, whereas the one in purple is the European market, again, the same market, but unhedged. So the purple line reflects the volatility of the currency as well as the underlying market exposure. Now, over this time, you can see that investing strategically in a currency hedged asset has had a really meaningful impact. So 18% of excess returns investing in European markets have been derived from hedging the currency. That's about 1.5% per annum on a nicely compounded basis, even though the currency itself has actually not moved in that wide a range over this period. Now, you'll notice that I've added a couple of sort of hyphenated boxes there. Now, on a cyclical basis, we've actually altered that currency exposure a couple of times in this period. And back in 2022, and actually more recently, starting in October of last year to current, we've actually unhedged some of that exposure. So we've increased the exposure to euro and taken it out of sterling. And that's from a cyclical macroeconomic outlook. And in both of those instances, we've been able to just incrementally add a bit of value to overall returns on a more temporary basis. But our starting point of picking up that extra yield from having your cash held in sterling versus the lower yielding Eurozone has been a real beneficiary here. So how does our portfolio look as a whole? We know that there's a range of different ETFs on offer to investors. How do we, as discretionary managers, think about putting all of that together into a portfolio? I mentioned we run 7 risk level portfolios. Here we show the exposure of our sterling risk level 5, and you can see that's a fairly granular exposure that we're looking at here. We divide each region up into different allocations, and we can change these around, substitute in, substitute out on a more cyclical basis, whilst we still want to keep that core sort of vanilla exposure to different markets. So just the fact that you're looking at an ETF portfolio doesn't mean that you don't have levers to pull to change your portfolio in a dynamic way. And so as the environment changes, we're very willing to think about whether there's a better opportunity for us to slightly change our market exposure, still using predominantly if not exclusively, ETFs. However, when thinking more with a multi-asset investor's hat on, we do believe that it's important to keep the overall aggregated risk of our portfolios much more steady through time. Here we show the historical shifts going back through time of our risk level 4 portfolio. The assets that are shown in green are our equity allocations. The ones in different shades of blue are fixed income, which you can see there have been some changes to through time. And then in orange and yellow, it's our alternative investments, which we really have started to increase ever since the sort of super low yielding environment of the post-COVID era. We believe that now you need to have slightly more levers available than just fixed income and equities to navigate through a more turbulent market environment. So that's why you see alternatives playing a slightly bigger role at the moment. I think I might just touch on this really quickly. We talked about the power of using ETFs. I wanted to just show the types of things that we're thinking about at the moment. Now, this is a slide that we've been using for a few months now. The headline still is very relevant. We think that the market really is awaiting clarity on what US trade policy is going to look like in the coming months and quarters. Of course, after Liberation Day, markets were really shocked by the size, the breadth, the bluntness of tariff policy. We've not got to an end point on US tariff policy. We don't think you're actually going to get to an end point for US trade policy. So we think that uncertainty is just going to be a watchword that many investors are going to be using for the foreseeable future. And now, of course, there are different. There's sort of a changing response to how the market is feeling about tariffs at the moment. The market seems to be a lot more reassured after the past few weeks compared to a couple of months ago about the outlook, based on how President Trump and his administration seem more willing to negotiate tariff levels and emphasize other aspects of their economic policies than people initially feared. But it does feel as though this is going to be a major driver of market direction in the weeks and months to come. We don't think that you're necessarily out of the woods with regards to the impact of tariffs, but we are also reassured that some of the very, very scary big numbers that we saw a couple of months ago are unlikely to be in place for a sustained period of time. We also think that there's a somewhat underestimated positive risk that the market has forgotten about some of the other more positive US policy goals of deregulation, lower taxes, and weaker energy prices, which are largely playing out at the moment. So wrapping that all together, what has that meant for Netwealth portfolios? Well, we've been running for just over 9 years now. We launched in May 2016. These are the sterling portfolios that we've been running since that point. You can see the 7 of them there have displayed overall positive returns thanks to an upward trending market environment that's been punctuated by periods of volatility. We know that you're going to see those through time, but we do think that the pattern there, that typically over time, investing in riskier assets, which are more ambitious assets like equity markets, tend to deliver higher returns over time, just a slightly more volatile journey. You can see that the returns have been positive. We're quite pleased with the outcome. We're also pleased with the internal consistency that these numbers display. And when we think about what that means relative to our peer group of wealth managers here in the UK, you can see that the performance looks pretty strong over that sustained period of time. And this is where we think that the tailwind of investing efficiently using ETFs predominantly gives us a real boon to performance. So at the higher end of the risk spectrum there, risk level 7 versus our competitors who are positioned within predominantly equity risk space, you can see a really significant performance built up over time. That's actually about 1.8% per annum. It doesn't come in, year out, but compounding up through time, getting that tailwind of lower invested costs has been really important for us. And it gives us the ability to scale our business and keep the net wealth costs nice and low as well. So at Netwealth, we make a big effort to combine the important parts of human interaction, so speaking to client advisors, receiving regulated financial advice when needed, and also an experienced, disciplined investment team. But without doubt, the tailwind of lower costs has really helped that. And you can see that come through over different time periods. So we're pleased with the way performance is coming up on a year-to-date basis. On the left-hand side of the slide, you can see that the numbers are positive in relative terms. And then that just compounds up over time, such that on the right-hand side, you can see again those since inception numbers, which, as I mentioned, on an annualized basis on this slide, you can see is nearly 2% for our risk level 7, generating 8% versus 6.2% per annum for the peer group. We're very pleased right now. There's a really nice snapshot looking at these 9-year returns at the end of May, because we can see that there's nice gradated incremental annualized performance as you take that increase in risk exposure. Now, of course, that doesn't happen all the time. And of course, past performance is not a reliable indicator of future results, as we're always minded to reiterate to our clients. But we think that the dependability of the process and the advantages that ETFs offer us are really helpful in this way. So thank you very much for attending this webinar. I do hope that we've been able to answer the questions that you may have had about how we think about investing here at Netwealth, how we think about the benefits of investing using ETFs, the important characteristics that we look for when choosing the particular ETFs that go into our clients' portfolios. If you do have any further questions about the ETFs that we have selected, or perhaps about how we run our investment strategies as a whole, then please do get in touch with my colleagues at advice@netwealth.com, or phone us on the numbers that you can find on the website. For now, thank you very much for taking the time out of your day to attend this webinar. Goodbye.